Welcome back to Money, Money, Money. This week we are talking all about alternate investment funds. So we've spoken about two important criteria, which is, of course, the complexity level of the fund itself, the return, what should one expect. Now, talking about liquidity, Vaibhav, do tell us what the stipulated guidelines are and how quickly, as an HNI, can I get my money back if I'm invested?
Sure. In a Category 3 fund, there is no restriction on whether you need to be a closed-ended fund or an open-ended fund. For us, we are a monthly liquidity provider. So if an investor comes this month, he can pretty much take the money back, in the very next month. However, what has been happening is basically there are some closed-ended funds which have been launched primarily to assuage the taxation concerns around some of those products. So we, as a product manager, have an option of having it open-ended or closed-ended. We think, in the interest of investors, we better be open-ended so that the liquidity is pretty much there and investor can take out the money as and when they want it.
You mentioned tax, so do explain that to us as well, because as Feroze mentioned, 1 and 2 enjoy the pass-through status where the end investor has to deal with the tax incidence.
Correct.
How does it work for Category 3?
So the basic difference between Category 1, 2 and Category 3 is basically Category 1 and 2 have a pass-through. In effect, what does it mean is basically the incidence of tax lies in the hands of the investor in case of Category 1 and 2, and in case of Category 3, the incidence of tax lies with the trust, which is the investor or which is the fund.
The fund itself, yeah.
Correct. We don't see any difference between a pass-through and a non-pass-through, purely because ultimately it has to be taxed at one leg of the transaction, and that is what it is happening. It's just that if the tax is streamlined by the income tax authorities, this whole category can appear hugely attractive to any of those investors.
So what do you mean by streamlined when you say it should be a little...
What we have been recommending is basically the incidence of taxation to be transferred from a trust to an investor.
Okay.
Currently, we are at the trust.
Which is pretty similar to the pass-through status that Category 2 enjoys.
The problem is pass-through is not a concession. It is just the transfer of incidence of tax from a trust to an investor. That's it. So telling that it's a concession, it's not the case.
No, but how does it sort of help? Of course, it does, administratively, I'm sure it kind of makes life a little easier because the fund house doesn't have to deal with the tax incidence,
Absolutely.
Right?
You are absolutely bang on target. In terms of the administrative complexities at the fund level, it's huge because the fund has to calculate the tax, pay the tax in terms of the advance tax, which supposedly happens 4 times in a year. And the resultant complications in calculation of your gross NAVs and your net NAVs is phenomenal. At the same time, there is always a limbo that at certain point in time, the investor would be taxed for some reason on the income which he received. Though that's not the case, but it's always it's on your back of your mind that an assessing officer can just come and at the lower level can raise a query.
What is the incidence of tax, the quantum of tax as of now on Category 3, and how is it defined? What sort of income are we talking about?
So the CBDT circular, in our knowledge, we are not tax experts, but in our knowledge, it says that the trust has the choice of paying or assessing the income as the tax they want to be. So like whether they want to choose it as a capital gains or as a business income.
Okay.
If the nature of the income is business, but you choose to be capital gains, it can't happen, right? I mean, it has to be sacrosanct with the objective it has laid with. So that is a choice which is given onto the fund.
Okay.
And that is how it will be taxed going forward.
So Feroze, what's the advice for those who are looking at alternate investments and looking at Category 3 funds? What would you tell your clients?
See, firstly, on the taxation issue, I think investors always like to have taxation at their end. Like, for example, if there's business income, there would be business losses.
It can be offset.
Okay, it can be offset.
Yeah.
If you actually, so it's not just from an administrative standpoint would I wanted all my incomes and expenses to be on one file. So it could happen that I've made losses in my equity mutual fund in the short-term category, and I still pay tax there. Then it hurts that you couldn't offset it. So taxation passing through, and like Vaibhav mentioned, if that gets more clarified and it actually moves on, then the Category equity will become far more lucrative.
Okay.
Coming back to what I advise to an investor on this category 3 is that you should look at category 3 from something which if you have a risk return profile which can be matched by a simpler product, I would always try to choose the simpler one, because you have to always operate at the LCM, least common multiple, and that's the fund of investing. So if you are not able to replicate it, like Vaibhav was mentioning, if it does not behave like equity, then there is a case in which liquidity becomes a very, very important part, because in the category 3, the fund manager's discretion to have it closed-ended is also there, because liquidity itself could have some complexity. So liquidity is very, very important. If you don't have liquidity, if you can't take U-turn on a road, just don't hit it and go on it. So that's what I advise to the investors.
Vaibhav, finally coming down to last thoughts, how is the AIF market evolving? What do you expect? I mean, we do see a lot more people coming in. I think the category 3 total size is a little over 4,000 crores right now. What would you like to see in terms of regulation, whether it's clarification or any additional sort of measures? And what about products? Do you think we will see more products anytime soon?
Definitely. You will see, very much evolving products launched onto the category 3. And the basic objective will be to address the risk return parameter of an investor. If somebody tries to do something on category 2 or category 3, which is replica of already which is being done, like Feroze mentioned, it's of no use getting into category 3. So if you are able to address the risk return profile and the behavioral aspects of an investor, category 3 is the place to be in. In terms of regulations, we would love to see some amount of clarity on the income tax.
Sure.
And if it's a pass-through to an investor, it would hugely help, not only for the investors, but also for the regulators in controlling the investors and providing with liquidity to the markets also.
Sure.
So it's an encompassing thing where you will hit on the positive sides across. So that's what we need in regulation side.
Okay.
In terms of the size, last but not the least, global asset allocation, about anywhere between 12 to 15% is into alternates.
Okay.
And in that alternates, about 50% is into hedge funds. So that's the size which we are looking. Though we are not even exposed to equity to that percentage, we would love to have some sizable share in the alternates.
Okay, well, gentlemen, great talking to you, and thank you for enlightening us on the world of alternate investing. That's where we'll take your leave on this week's episode of Money, Money, Money. Of course, your feedback, questions, comments are welcome as always. We'll see you again next week.